Thanks, everyone. Thanks for coming this afternoon. I am Barry Sternlich. I'm going to be the moderator here, which is going to be fun. We're going to make this lively, as we usually do. Sam and I have done this together many times. I'm going to start out just really quickly. We're going to try to spread our conversation evenly, cover a lot of topics, and if we have time, we'll do a Q&A at the end. As you know, this has been a really good time for real estate, so I'm going to just talk about the background, and we're going to talk about where we're headed from here. Does this work? First slide. There we go. Well, that's sort of interesting. It almost worked. There it is. So this is a slide of interest rates, and the red dots are real interest rates, and the blue bars are nominal rates. And you can see that on this slide, probably 80% of the sovereign wealth debt in the world is negative. It has negative rates. So the question for investors, for us and what we do, we're about a $56 billion asset manager today, is what does this mean and what is going to happen? And as we have a new fiscal policy in the United States, potentially, with a lot of stimulants coming, presumably, some will make it through. And then what happens in Europe and the rest of the world. Also, it's interesting that Brazil, as you'll see, has the highest real interest rates in the world. And inflation's falling rapidly. And as they do that, they've been able to lower interest rates, and the currency has held because of these high interest rates. It's still an attractive currency. So that's an outlier. Sam will talk about Brazil a little bit when we get there. And what this has led to is we are the prettiest girl at the dance. We are the best performing asset class of all the major asset classes. So over 3 years, 5 years, and 20 years, the dark blue line is the Nareit index. The blue line is the S&P, and the green line is, I can't read it actually, I can't see it from here, is the Barclays Hedge Fund Index, which I like because we've crushed it. And now I have a lot of my friends in the room probably who are hedge fund managers, but it's been a really tough time for them, and I think structurally their business has changed. And we are a yield alternative. At the end of the day, real estate produces yield. Some of us buy it and fix it up. We have many colleagues on the panel here who develop it. Rick Caruso, who starts from nothing and develops yield product. Eric and I, for the most part, buy it. We build it too. Sam buys it only when it's dirt cheap. And Ross Perot's done everything, built it, bought it. And Don Peebles also is a developer. So there's many ways, but this question is, will this asset class continue to perform like this going forward? It's had a good run. And the one thing that I know is, well, it's in front of you, but it's not up there. Can we get the next slide up, please? Slide 3. So this is the U.S. budget, and this slide was put together before Donald's tax cut last week. And it was just the lack of reform for entitlements that would have driven, you're having some technical issues here, huh? The deficit to nearly $1 trillion again, because no candidate, Donald, Hillary, nobody was willing to talk about entitlement reform. And if we don't fix it, we're going to have $1 trillion deficits again. And then if you I don't know what the annual cost of Donald's proposal is, but it's not positive short term. Even he says that. So if you have $2 trillion deficits, who's going to buy all the debt? And what does that mean for liquidity in the world? And then you throw overlay on that political discussions like China's a currency manipulator, or a trade war, or selective trade wars. And maybe people don't buy our debt. So for me in real estate today, and we'll talk about the panel in a second, why do rates rise? If rates rise because the economy is moving ahead quickly, that's okay. Rents will move. We'll talk about why rents will move. Rents will move in almost every asset class because the baseline for real estate today is probably the best of my life. I've been doing this 30 years. There's basically no excess supply. There's a couple outlier cities, New York and hotels, and some other places, resi in New York. For the most part, this country is pretty balanced in real estate, and we are not an issue anywhere. The banks haven't been lending too much money. It looks good, but if that deficit explodes, and it's supposed to get bigger, and this is, again, before the tax cut, if you believe the economy is going to race ahead, maybe you can fill the bucket. They're going to have a debate about it in Washington. But if rates rise because there's just too much supply, because we're running a $2 trillion deficit, that means maybe we don't have economic growth. And that's probably bad, right, for real estate. There's no rental pressures, no wage growth. And the rates rise because there's a buyer's strike, because the Saudis and the Chinese are angry at us, because we've done some political maneuvering. That wouldn't be good for property either. So why has this been such a good period for us? This is if you look in where the red line and all those other colors converge, that's 07, 08, where really good assets traded below the cost of debt. That's actually the 10-year treasury, the red line. And those are the yields on all the different asset classes. But what's interesting about this slide is that actually you have to add the spread to the treasury. So you had negative leverage. Your cost of debt was higher than your yield on your property back in 07, 08. That was a different time. This is the United States only. You used to go to Japan to see these kinds of spreads between property yields and the cost of debt. And today the 10-year is lower than it was in January 1st of 2016. So that's before Trump ever raised his head. And that's amazing to me. And I'm not sure what's going on other than large short squeezes, but you would expect some of what's going to come in 5 different fiscal stimuluses to move rates. That means it's still okay to invest today, but you have to have a view on interest rates. And this is a diagram of that. We're around the long-term average, so nothing's really changed. This is a really positive thing for real estate because if we get the base case scenario of inflation coming back because the economy's picking up, replacement cost goes up, and rents will have to rise further, and there'll be economic growth and wage growth in order to justify new supply. So I still like our asset class. I used to say when I've been here a couple of years, I don't think I was here last year, this is the best time in my career in this sector, and our returns show it. And that's the why. So that's real estate supply. That's all assets. And those are forecasts, but you can see that we're not building that much. And for whatever reason, we have not really built that much. So the markets are in relative equilibrium. So I'm going to sit down, and we're going to ask the panels a bunch of questions and see if they agree or disagree on everything I just said. And I'll find my notes. Okay, so good. Let's start with Eric. So I didn't introduce everybody. I should have done that. Eric is with PGIM. They own $40 billion of assets in the United States. It's the domestic arm of Prudential Insurance that's been renamed, which confused me. And they're an asset player all over the world. So, and everybody should ask each other questions. I want to make this as informal as possible, but talk about capital flows and what you're seeing in the business today and where you see the opportunities.
Yeah, sure. Well, I'd start by saying that capital flows, when you really think about cross-border capital flows, they've been higher than they've ever been ever since the global financial crisis. With what you just described in terms of the interest rate environment, real estate got very attractive for a lot of investors, and you had the usual suspects that were international investors pre-crisis come back in pretty quickly, and a lot of what we call hot money that look to play counter-cyclical markets, but a lot of players we'd never seen before. Fixed income shops, some of the private equity shops that we hadn't seen prior to the crisis came in. We even had cash boxes getting listed in places like Spain. But I think the real game changer was the Asian institutional money. They are not hot money, but they think like opportunistic investors. So their ability to react to different changes and opportunities around the world was much quicker than we anticipated. And what it's done is made this money move much more quickly than we were used to. Prior to the crisis, and you've seen this, you could find an arbitrage opportunity in a country, and it could last a good year or two, sometimes 3, before all the money came in. It's really, these arbitrage opportunities started getting closed within a matter of months. And so it became a very attractive asset class, but very much a momentum game. And that all changed last year with the volatility in the Chinese markets beginning of 2016. With where prices had gotten, that had really frozen the flows in the US. And on the back of that, you had Brexit, so a lot of the foreign money going into Europe generally slowed down. They didn't know if that was more a UK phenomenon or a European phenomenon, so they stopped their investing in Europe generally. And on the heels of that, we had the US election. And again, that gave a lot of foreign investors some pause for thought. Paradoxically, for relative value players, that was a better environment because local money is not going to be as correlated as global flows. And so we were starting to see differences in pricing in markets, and I think that money's coming back. So the real question is how strongly it'll come. I've never seen as much of a discrepancy between investing intentions and actual transactions. But if the transactions start matching the intentions again, I think we're going to be off to the races.
So are you a net buyer or net seller today?
It's schizophrenic. We're both. So there are a couple markets.
So I think transaction volume in Europe was down like 40% in the first quarter because everybody was waiting to see the French elections. And this chart is the first quarter capital flows. And you can see from China, despite the capital regulations, they were able to get some money they had offshore, almost $5 billion of capital. It's the single most important market in the United States. It's the second orange dot on the top there. And you can also see the relative lack of importance of some of the other countries. Australia, very big into the US too, and so the funds. Are you seeing pricing flat or back flat or what? What are you seeing in yields?
It's flat. It's flat because, again, there was such a, there's still money coming in, but not as much as there was before the beginning of last year. And so prices seem to be flattening out. Supply and demand, as you said, is very attractive. So people are betting on rents, their ability to go
And
up.
what do you think the foreign bid is versus the domestic bid? Is it 100 basis points wide, or is it 50 basis, or is it right on top of it? Is there a second, are they outlier bids in your book today? Or?
Yeah.
They are.
Yeah, especially global gateway core. You have a lot of the, particularly Asian money is still quite aggressive because they play a long game.
Is it Korea or China or Japan?
If I had to pick one of the three right now, it's more China. Korea's been more consistent throughout this cycle, and Japan is the one to watch.
Sam, you wanted to talk a little about capital flows. What are you saying? Because you have these guys as clients. I do too, but I'll let you talk.
I just look at the markets and I look at the supply-demand equation, and I don't see the demand.
The demand to fill office
I'm talking
buildings?
about real estate capital. In other words,
Real estate capital.
In other words, when you talk about various forms, whether it's office or retail or apartments, or hotels, we're producing in the U.S. significant more supply than there's demand. And I think we're, from a real estate point of view, not in a particularly attractive market.
The U.S.
Yes.
So then I have to ask you what you like in real estate, since it's a real estate panel.
Well, I mean, we made them.
You're not allowed to talk about. Oh, he's got a new book coming out. I have to tell you about his book. It's called. He likes his book. Am I Being Too Subtle? Is the name of his book. And it's coming out next week. So if you're around in a week, he'll autograph your book. But
Hopefully, demand there is much better.
very
than
strong. Nobody's ever accused you of being very subtle. But anyway, so go on. What do you like?
I just think that the overall real estate market is benign. I think the odds are that the performance is going to be less rather than more. Apartments, we're building more multifamily than we ever have before. We're building a lot of hotel rooms. We're building a lot of office buildings that I don't know where the demand is going to come from. And, we've been through, as the first chart showed, a wonderful cycle. I think
a
the
historic cycle.
I think the real estate cycle is coming to an end. And I think that the oversupply of capital is much more capable of turning on a dime than most people expect.
So do you think, is that based on a forecast for interest rates also? What do you think the 10 years 2.32 today? Where do you think it'll be in 12 months?
Higher. I mean, the answer is...
233?
Yeah, I mean, the answer is that, there are so many different factors that, inflation, demand for capital, the Fed has got, 3 trillion or 5 trillion, and they're going to, over the next supposedly 12 to 24 months, they're going to sell that to who?
The Mexicans.
That's the same issue of the dollar. In other words, how strong is the dollar? And, if you didn't have all of the risks worldwide, the dollar would be a great short. But I think it still represents safety, and that's holding it in place.
Somebody up here has to. I
disagree.
Right,
I
there you
completely
go.
I disagree in
Okay, Don's a great developer, and he's building almost a $500 million project right now in Tribeca. And now
Yes.
go ahead and disagree.
and obviously, look, I think that in some markets, the markets that were struggling and were hit the hardest, there's a constrained demand. But in terms of global markets, New York City is the best real estate market in the country. There's a demand.
You're talking long term.
I'm talking long.
Not next 12 months.
And I believe also on the short-term basis. I think New York, for example, is a safe haven, a global piggy bank for protecting assets by using New York City real estate. So
it's not Miami. I
well,
was kind of hoping it's Miami. I just moved there.
well, Well, nice thing, look, if Trump gets through his tax break,
Miami's the
then
place to be.
Miami will be the place to be. And I think that Miami is another city that is catching its breath right now, but there's still demand there. Now's the time. We're a net buyer in New York City. We think now that the market's getting a little gun shy, that land prices have gone down. We are seeing a slower velocity in terms of residential sales in Manhattan.
And prices are down, and rental prices are down.
Rental prices are down because at a certain point, rents were hovering around $100 a foot, and for luxury product, and the economics, those compete with the cost of buying, and so people have been pushed into buying. So I think that we're seeing, the market kind of catch its balance, but product is still selling in New York. You can ask Howard Lorber. I saw him here somewhere. Douglas Elliman's having one of his best years. So I think that, in places like Washington, D.C., real estate market on the residential side is doing well. I think the challenge is going to be retail. I think that's where we're going to see some
That's
challenges.
a good segue to our next
I was gonna
guest.
say, wow. That's perfect layup. Thank you for that.
You're
We
welcome.
have Rick
he's
Caruso, whose Pacific Grove development here has been compared to retail Disneyland. And he has 3 major developments that I know of under construction.
Right.
And we'll talk about, and then we're going to get to Ross Pro Jr. over here because he's building the warehouses for Amazon that are destroying your malls. So let's.
So let me give.
I try to get a little excitement here.
Let me give you my view. I can give you my view about my world. I don't deal on a global basis. I find it fascinating to study it and hear about it.
That's
I
why it
certainly
looks like that. He doesn't travel like
respect.
the rest of us.
But I'm sort of old school, and I believe that real estate is very much a local game, especially when you're dealing with retail. Because if you're going to be in retail, you need to understand who your customer is. That's always been the premise of it. You need to understand what their expectations are, and then you need to exceed it. I said in the back room, which shocked my fellow panel members, I think Amazon e-commerce is the best thing that's happened to brick and mortar. And let me tell you why. We run at 100% in our portfolio. Our portfolio last year in terms of growth grew at 8%. One of the biggest back orders that we can't fill is space. And the e-commerce providers are demanding to get into brick and mortar, including Amazon. But what I like about it, and there's a path to great brick and mortar, you're not going to save bad retail. I don't think you're going to save indoor malls. 4 years ago, I gave a speech in NRF, and I said the malls are going to die unless they're massively reinvented. I still believe that. And all the papers now are reporting on that, and the capital markets are reflecting that. But is there a path for them to flourish? Yes. Good brick and mortar is going to flourish, and it has. Our portfolio has. Retailers, because of e-commerce, are going to get smarter, and it's data-driven. So we spend an enormous amount of time on intercept studies. Who's our customer? What they want? What their expectations are? And if I viewed myself as being in the retail business, or I viewed myself being in the apartment business, because we build luxury apartments, and we do office, and I didn't view myself as what the customer wants, I'd be out of business.
So how have you changed in the era of the internet? How have you changed your retail strategies?
We haven't changed our retail strategies. It's always been about exceptional service. It's always been about hospitality. It's always been about understanding the customer. And we actually spend more time de-leasing, taking space back, than we do leasing. Because the minute a retailer starts losing their way, we want that space back and we will repopulate it.
There are a lot of retailers who've lost their way.
There are.
And
But
they're fearful and freaking out.
But there's also a lot of retailers who are great at what they do. And if you focus on the retailers and the restaurateurs that are great at what they do, that they understand that inside their 4 walls, they have to have a great experience, connect to the customer, be relevant, sell a product that actually people care about, and don't have a business plan that is based on competing on price. Because when you compete on price, hold on, when you compete on price, you're in a race to the bottom. And the stores that are going out of business, the Macy's of the world and everybody else that's closing down, the Sears, the JCPenney, it's all competing on price. You have nowhere to go. Retailers that provide an exceptional experience a great product that's curated, that actually is a merchant, not a retailer, are doing exceptionally well.
You have department store anchors in your malls?
Yes, they're
Who
up.
are they?
You can call the Nordstrom Brothers. They're thrilled that their stores are up on my property. You can call Philip Grain. Stores are up on our property. So we grew at an 8% clip. I can't tell you why. Well, I actually can tell you.
Those are California assets, right, pretty much?
Those are California assets.
The economy here has been pretty good.
No, but you know what? Barry, with all due respect, I think that's and I don't mean this in the wrong way, I think that's a lazy argument. I think it's a lazy argument. If you're a good operator, and an operator, not a passive landlord, if you're a good operator and you know how to drive sales, if you view your customer as your guest, and you make it a happy environment, a pleasant environment, and you exceed expectations, you drive sales.
Should we all sing Kumbaya?
Yeah.
Yeah.
What do you say?
Can we all sing Kumbaya? Yeah.
Well, it's not.
though?
What you're saying is not actually contrary. Most people feel A malls will get stronger, and C and D malls will disappear, and then the B and A malls will get better because the C and D malls went away, and those stores will consolidate, and we're going to lose 100 million square feet of retail space in the United States for sure.
That's still not going to
And
save
in
the rate.
Dallas, where we own Willow Bend Mall, 2 of the 5 malls are closing.
That's right.
So, and we're doing what he's doing, what he
It's not
did.
limited
Grove.
to Dallas.
No, it's the whole country. And we own a mall in Lincoln, Nebraska. I mean, we're the only game in town, but that doesn't help us too much. What is your view as an investor towards retail? Are you fearful? Are you buying it or not?
Yeah, we've been net sellers because of the pricing, right?
Right.
It is a confusing time in retail, and I agree. There are some
Fortress real estate.
Yeah,
right?
some fortress real estate, but the general trend is there's too much of it out there, and the U.S. is probably the most extreme.
But just so you
example.
know, I don't have fortress real estate. At the Grove, we do $2,200 a foot. I have the Beverly Center 3/4 of a mile away from me. I have Century City 3 miles away from me, and I'm surrounded by retail stores.
That's not
So
fair.
why are we doing $2,200 a foot and the average mall's doing $400? It's the same product I'm selling.
Well, the bottom line is,
So it's
generally
not
speaking,
fortress.
they're not all like you. though.
Again,
That's-
and with all due respect,
What percent
the
of
people that are
Pacific?
doing well in retail and in brick and mortar or luxury residential are providing an exceptional service. That's what people want today.
Well, it's
Couldn't-
high end
couldn't
though,
agree
isn't it? I mean, it's a. What percent of your center is entertainment focused? Would you say restaurants, theaters, everything else? Is it 10 or 30 or 50?
It's probably 10 to 15%.
So it is inline stores.
What I will say, the one place where we're still buyers is Center City, right? Good high
Center
street
City retail.
retail, and it's mainly because we feel good about if you price it right. Over time, you can find repositioning opportunities.
All right, I want to get to Mr. Perot over here. So if people don't know, he's one of the most incredible developers in the United States, and he built a little airport on an 18,000 acre site called Alliance, and then he built all the intermodal transportation systems around it, and then he created a city basically that employs 50,000 people. I said 47,500 out there to him, and he said, no, it's 50,000. So the Wikipedia was wrong by 2,500, and he's not finished. But what he wanted to talk about was technology's impact on real estate and what he sees coming, and how it'll affect everything in property. And I'm going to give it to you on that. And he does a lot of work for Amazon. Built 10 1 million square foot distribution centers and has 8 under construction.
I mean, we're mainly industrial developers across the United States and in Europe. And as I was talking to Barry, the industrial market would be a fine business right now, but with the I-fulfillment boom, it really has become a very strong business. We have 8 Amazon buildings in production right now. We're negotiating another 8 or 9. And with Amazon, you're always working deals. You're always trying to find land. And there's a big group of us that compete for the Amazon business. So the key is who has the land. And then you get closer and closer to your client. You find out where they want to go. But then, the Amazon boom is stunning to watch and how they're changing, basically retail in the United States. But now Walmart, we're doing work for Walmart because they want to catch up. All the major retailers need an I-fulfillment presence. And so it's the industrial community that's helping them get up to speed to compete with an Amazon. And then you have UPS and FedEx. And so we help both UPS and FedEx build their I-fulfillment facilities. So it really has been a huge energizing movement.
How does the little guy compete against Amazon Industrial? I mean, they're going to build, how big is your average Amazon center?
1 million square feet.
Right, so if you're like, I don't know, Kate Spade, you're not gonna build, why don't you just
Well,
give up?
we
and
did
let
a
Amazon
million square
distribute
feet for
you?
Kohl's.
Yeah.
You know, we do multiple million square feet
But in
for
a city like
for Walmart,
Dallas,
for
how many
sure.
fulfillment centers will Amazon need?
Well, we've done 2 million at Alliance, 2 million at DFW Airport, and that's what we did, and the other developers did a couple more, another
There's
couple
like
million.
10 centers serving
So all
Dallas.
serving, population center of 7.5 million.
And talk about your helicopter.
And so then what we announced last week with Uber is the new Uber Elevate, and we're developing the first the vertiports for Uber in Dallas-Fort Worth. The second city is Dubai, and Uber convened all the manufacturers, the FAA, which I was amazed how far the FAA is going with drones and passenger service and package service with drones. Then the work that NASA's doing, developing the airspace and the modeling for the drone business. And I've been a pilot for a long time, so it's hard for me to understand drones and airspace, but after being with them last week, it really is a viable concept. And so they're developing a vehicle that'll be electric powered, it'll be quiet, and you'll have these series of vertiports around the major cities that'll be linked in with the Uber app. And so we'll be pioneering that over the next 3 or 4 years in Dallas-Fort Worth.
So you think in 5 years, let's assume Amazon stays in business, which I think is a safe assumption. You're gonna order your paper towels and they're gonna deliver it to some station with a drone, and the guy who gets hurt is UPS and FedEx because they have all these centers.
I think
and drivers.
after
local
spending
delivery
time with the
drivers.
Uber team last week, what Uber envisions is the drone lands on top of the Uber car, then the driver delivers it to the house. So Uber does the last mile. Because it's still, to me, again, I'm old, and a pilot, it's hard for me to imagine drones delivering to every home. I mean, you're going to have packages dropped in pools, dogs
you're
are
gonna
going
have a
to use. I
large
mean, there are a lot of problems with that. But I do think, the drone on top of an Uber with a human delivering to the front door is at least a valid first step in automatic delivery.
I think in Texas they'll use them as clay shooting targets.
I think
They'll stand outside and knock 'em out.
There have been rumors that, Barry. So I think a few drones
Come on, how are they going to stop people from
drones
shooting
have been
them?
shot down.
They're going to
Yeah.
shoot them down. I know that. I would shoot them down. It'd be fun. That's crazy. But I don't understand. I mean, for real estate, logistics has been probably one of the strongest, if not the strongest asset class. And it's followed, in my opinion, interest rates, right? Like all real estate, because
Sure.
cap rates crashed the institutions, the foreigners, really have focused on that as an asset class to own, because it's sort of a portfolio of credits and corporate bonds.
It is. These are long-term credits, but also huge demand. I mean, the buildings are being built and the buildings are filling up around the country.
People
So
may not know the vacancy rate in LA in industrial is like 1%. So there is no stronger market, I think, in the whole globe than the
And
LA
we've been
industrial
developing here for
market.
20 years. I mean, it's a phenomenal market.
You buy Air Force bases.
Well, we reconverted the Norton Air Force Base,
Right.
and that was a great program for the Air Force. Now we're at March Air Force Base, redeveloping March. And so we work a lot of these public-private ventures in order to find enough land to do these big logistics projects.
And it's business as usual for you in this climate.
We don't see anything slowing it down. Now, we've had a great run. The country's had a great run, so you're cautious. But as long as the demand is there, we'll continue to build and take care of our client base. But on technology, the drones are fun to talk about. The driverless truck, that's real, and that'll have a big impact on our business. We're trying to figure out what happens to the distribution patterns in the United States when you have the driverless truck.
And the driverless car.
What?
And the driverless car.
And the driverless
Because the
cars.
driverless car, we're spending a lot of time working with technology partners because we're going to get a lot of good real estate back. You won't need as much parking.
Right. It's one of the
And
worst.
so you're going to get
investments in
real estate back with zero basis. It's going to change the pattern of how people live, how people shop, how people go and dine on the driverless car, which I think is one of the most exciting changes for the real estate industry that's going to come down the path in 10 or 15 years.
Yep, and Eric Schmidt, I was at a thing with him last night, and he said it's a year away. It's not 10 years, 5 years, it's a year away. And they can't do it in California because they won't let you do it, but they'll do it in Arizona. They're starting.
But it will happen, though, eventually.
But eventually.
Yeah.
He was funny. He made he said it was analogous to like everyone's driving around in horses and then a car shows up. And then California would outlaw the car because it's going to kill all the horses. So, and that's what the driverless car would be. And I've seen this car, and I've sat in it, and it's better than we are. It drives better than we do because it can see in all directions. You can't. Humans see one way. If there's a lady crossing the street, your eye goes there, and there's a boy coming across on a bike, you can't see him. So it's ever learning, as you know. So let's talk about the U.S. economy for a second. Let's get away from what is your outlook? Because we're all investors in one way or another. We'll stick on the U.S. right now, and then we're going to go to Europe and Brazil for Sam. All of Latin America, but what is your outlook for the U.S. economy? I mean, what do you think GDP growth is going to be? And I'd like to know where your take is on where interest rates you think will be and if it matters. And let's take 12 months and 5 years, or 3 years. Nobody can do 5 years, not with Donald Trump in the presidency.
Yeah,
Actually, we can't even do a week.
we think 12 months is more the same, and this first quarter is indicative of that. Slow first quarter, it's going to be, it's just a steady.
Pathetic first quarter, not just slow. It was pathetic. It was worse
but
than 3 years.
there's some extenuating circumstances.
some
We've had
inventory
that. It's
adjustments.
more that's been happening for several years. Some extenuating circumstances around a slow first quarter. So we think it's pretty flattish for the next year or so.
The economy and rates?
Rates will go up, but not. Our view is the rates are going to go up fairly marginally.
And what does Donald get? I'm going to ask everyone the same question. What does Donald get through this year? What do you think?
Sorry?
What does he get through this year? Infrastructure, deregulation, tax cuts, healthcare. Does he get anything done?
I really don't know if much actually gets concretely done this year.
I actually have a different perspective. Look, one of the things that we got to keep in mind about our business is that we have these cycles, but they can get extended. And so, Reagan propelled a rebound of our industry in '81 with tax reform. He used tax policy to jumpstart the real estate industry. Sadly, 9/11 and then the economic stimulus that followed it extended our run in the real estate industry again. I believe that Donald Trump and the Republican Congress will ultimately pass reductions in tax rates. I believe that
This year?
This year. I believe that, and I think
What will it look like?
I think it'll be somewhere between 15 and 25% as a top rate for corporations, and that comes with. It has to come with a similar cut and similar rate for pass-through entities, which will be our business, which is real estate. So, for example, we were beginning to abandon future condo developments because in New York we're paying 54% of our profits in taxes. But if we are taxed at 15%, it makes the market look a whole lot differently. So I believe he'll get tax rate reduction. I believe that we will see significant regulatory reform. He's already started with executive orders. I believe that there will be a reform of healthcare, a tweak of healthcare reform. He will get some alliances that have taken place before. I believe, for example, with the death tax, that's going to get reduced to zero. The Congressional Black Caucus, which is now 50 African American members of Congress, voted with George W. Bush and left the Democratic caucus to eliminate the estate tax because they feel that that's one of the ways African Americans can advance economically is to pass on generational wealth. So I believe he's going to get those things through. Infrastructure is going to be another story because I don't think there's going to be the financial resources to pay for it. I do believe that they will use health care and an elimination of some of the tax deductions for high net worth individuals to pay for this tax cut. But there, you've got a Republican House, a Republican Senate, and a Republican president. And I think if he's smart, which I have every reason to believe he's surrounded by smart people, that. Not to say that I don't think he's smart, because he is smart.
You
and
just
if
said
you're
that.
listening, Mr. President,
You've
you
been
are
edited.
one of the smartest people we know.
You can't have a qualifier on that statement.
So, but I think that they will be able to, if they get a simple majority out of the Congress, then they'll get 10 years of tax cuts. If they can trade off some of these things, like the big trade and the big issue is going to be the deductibility of state income taxes. So California and New York and New Jersey, these high tax states, will be decimated. Connecticut, which was also dishonest because it tricked a lot of people to come there. Are you still there?
Nope. No, I'm not.
I preferred Florida. But I think that I think that's going to be the trade. I think the trade's going to be that and
Rick,
giving some back.
You have an opinion on this?
I think
You
interest rates are going to stay low. I don't see any pressures that are going to push interest rates too far high. I think Bernanke said this morning he sees them stabilizing around 3%. And I have a different capital structure. So I build everything on my own balance sheet. We do my own equity to debt. The banks have been great. I invest for long term. I build. I've never sold anything that I've built. And so from a long-term perspective, I think it's down to fundamental real estate principles. If it's great real estate, well located, in areas that are demographically strong, educationally strong, et cetera, I would be investing. And infrastructure nationally, I don't know what's going to happen. I hope it happens. The good news here in Los Angeles, we overwhelmingly passed a $40 billion infrastructure bill for railroads and transit and everything else. So no matter what else is happening in the country, LA has taken the lead, which I think is great. California passed a $5 billion infrastructure bill, so there's going to be a lot of good things happening. And I'm very bullish on California for the long term.
Do you ever sell anything?
Oh, yeah. Yeah.
Curious if it was.
Oh, for sure. No, we market time.
And what is your base case on this economy? You think so?
I don't see there's a real driver for rates to go. I think 3% is normal. I mean, I'm not as worried about rates as I am labor.
Yeah.
The biggest problem we have in Texas and really everywhere we're developing now is there's not enough men and women to do the work. And there's a labor shortage. We see labor inflation. And so, the building products we'll build will be fairly simple warehouses and industrial. But our complex buildings, I'm not sure in Dallas-Fort Worth I'd want to start a new high-rise office building right now because of our labor problems.
You can't find people to serve lunch in New York in our hotels,
Hey,
and our home builder can't find workers to build the houses that and that's why we're not building enough houses.
And we're going to need an
that's why
immigration bill
prices
to
are
get a
going
lot
up.
of the labor back into
Sam,
Texas.
what do you think about this economy with Donald?
I think Donald has an extraordinary opportunity to create a massive amount of stimulus by deregulation.
On that
And-
single measure alone,
I'm
which
sorry?
he can do on just that.
In other words, frankly, if he just stuck to that and didn't get involved in all this other stuff and focused on deregulation, I mean, we've just come through 8 years of the most regulated government in the history of our country. It's not accidental that the president who focuses on income redistribution sacrifices growth for that objective. And I think that's what's happened. I think that's Donald's opportunity. If he can do that and not get distracted by his Twitter key or other stuff that he keeps, veering off, and he's got an opportunity to be a great president.
I agree. I think he's got an opportunity to be transformative because with Obama, who I was a big supporter of, the challenge was that the country was at its knees. And so the constraints put on our free market system were paralyzing. If we look at our industry, because we're focused on real estate, you look at the capital structure and the constraints placed on the financial institutions to make good business decisions. They were very difficult. And in fact, that's choked off demand for residential housing, condos, single-family homes. The biggest challenge is buyers being able to qualify for mortgages or to come up with a 25% down payment because, again, the regulatory environment. So
It's not all that. I mean, kids have $1.4 trillion of student debt, right? They had 400 or 500 when Obama came into office. So somehow we levered up the kids who were the first-time buyers, and they don't have the money for it, even though they can qualify for an FHA loan and get 97% financing even today. So that credit thing I don't buy. We've started and just left the 8th largest home builder in the United States. We started from scratch. And the issue is labor and cost of labor. And then the markets, the housing complex, because we have a public company that rents homes, and we own a ton of apartments, that's just Sam and most of you guys. I mean, this is the best resi complex I've ever seen, and it's unbelievable. And it should stay as a baseline bedrock for a growing economy going forward, especially if income shows up. So let's talk about international for a second, Sam. I mean, do you operate outside the U.S. too?
Poland and Germany.
Okay.
Building
Okay, we'll
houses.
start with Sam because we can talk about Latin America, China. Would you invest in
Yeah.
China today?
We we previously invested in China until our partners stopped speaking English. The answer is, you know, there are no.
You're not being too subtle at the moment.
Barry, there are no investment opportunities where capital is not short.
Yeah.
When China was short capital, there were great opportunities in China. China is not short capital. And consequently, I think that there's limited opportunity. At the same time, we've been in Brazil, out of Brazil. We're now going back into Brazil. I think that, you know, it has all of the characteristics.
Are you in Argentina?
Never, no. We've been in Argentina years ago. But Argentina is a criminal enterprise, for lack of a better word. I mean,
It is the best performing stock market in the world 2 years in a row now.
well, I mean, you look at what goes on there. You know, for 10 years, nobody paid their electricity bills. Nobody paid their telephone bills. You know, you've had Peronist philosophies that have taken what in 1920 was the 5th largest economy in the world and turned it into, you know, Zimbabwe that speaks Spanish.
Okay, what about Colombia and Mexico? Do you like Mexico here?
We have a lot of stuff in Mexico.
You do, I know you do.
I think Trump is doing Mexico an enormous favor. I think Mexico is going to come out of this current period dramatically stronger than it has been in the past.
Why is that?
I talked to my people and our partners in Mexico, and I thought they were going to be very depressed. Instead, their attitude is, you know, he's forcing us to figure out where our markets, other than the U.S., ought to be. And they have a lot of markets to export to and a lot of markets to import from. I mean, just in the last, you know, Mexico is the largest buyer of U.S. milk, $1.6 billion a year of milk. Guess what? There's excess milk in New Zealand. They can buy it from New Zealand. So I think Mexico is in a great position, and I think it's going to, the fact that the peso is down is an enormous opportunity.
What about Poland and Germany? We can move to Europe for a sec.
The demand in Poland is good. Germany is okay. And we're in Poland because of labor rate. You can build warehouses and distribution centers in Poland and deliver into Germany. And so it's the labor, the availability, and the Poles are hungry.
Yeah.
I mean, they really
work.
want to build a country, and they've got great ambition. And they're it's the kind of area that when you invest, and they love America,
Yep.
very pro-American. And so when you're there and you're building, there's competition, but it's not near as competitive in Poland, Germany, as we see in the United States.
We own some buildings in Krakow and Warsaw, but they're building. They're adding supply in these markets as they, you know, it's not Paris or Berlin. There's too much land and too much stuff they can tear down and rebuild. Eric, what do you think about Europe in general? Because I mean, I think our view is Europe is much stronger than we thought it should be, but these are constrained supply markets. And in the hotel space, they're having the best market probably in the whole world.
Yeah, if I look at, when we look across our business globally, that includes LATAM, I very much agree with the comments on Mexico, maybe not as certain how much they can exploit some of the further away markets, but generally very constructive on our Mexico portfolio. But in Europe, continental Europe, supply has been extremely constrained. The economy is doing much better than people would have expected.
Impressive.
And we've got a sanguine view on the outcome of all these populist elections coming up. Holland's gone well. France, we'll see. Cross your fingers. You have to have some humility on outcomes, but it does look unlikely that Le Pen passes. Germany, as always, is very stable, so either outcome is okay in the grand scheme of things. So value-added opportunities across continental Europe, the bigger cities, Germany, France, Paris.
And you're active in all the asset classes?
All the asset classes, yeah.
You hotels?
Hotels, not as much.
Too
but
bad.
For the
I
next
can tell you a
cycle.
few.
For the next cycle. And UK debt, very attracted to the debt play in the UK. Brexit should have a big impact on central London. We haven't felt it enough in the prices on the equity side, so we've been net sellers of buildings, but we've been underwriting a lot of great mezzanine product because the banks are scared. So a lot of good products just aren't getting the financing they have.
Let's take some questions. We have 10 minutes, and if you don't have questions, I will keep going with the panel, but we want to give an opportunity for people to ask questions. I mean, we're active all over the world, so. Is there a mic? I can't. Now, with the lights up here, we can't see anything.
There's a mic there.
Oh, there's a mic, but there's no hands. Anybody have any questions they want to ask us about anything? Harrison, are you thinking of raising your hand?
Any views on other countries in Asia aside from China, like Japan and Southeast Asia?
Yeah, maybe because that's the one thing we haven't talked about. When I think very long term, we are most constructive on Asia generally. And that's, when you look at Asia historically, Western investors would go there because it felt more volatile, but there was more structural growth. At least
You're
that was
including China in that comment?
Well, so let's put China aside. China, I think China's like an on and off switch. When capital controls are up, very hard to buy because all the money just stays in the country. When capital controls are let up, places like Shanghai and Beijing, you will find opportunities. We bought a building in Beijing beginning of last year when there were a lot of capital controls. It's worth 35% more now. So it's a tricky market, but watch those capital controls, and you can buy at certain moments in China. But otherwise, the rest of Asia, the volatility that everyone thought was at a premium in Asia, when you look at what's going on in the West, I don't think that's the case anymore. So you still have a story.
We have to exempt Korea, I imagine.
Well, you know what? Right now, one of the best, if you can get cast iron stomach, no question, because there's an asymmetrical risk going on. But
Why would you take that risk today? I mean, why would you even bother?
Well, so let's think about it this way. If the worst happens, what you're thinking about, where exactly do you buy real estate? What do you think is going to happen for a long time after that kind of a conflagration, right? It's a bit of a, if you're really thinking that you could have war out there, I don't think you buy real estate anywhere, right? Till you let that pass. So you've got to keep
Actually, I just disagree with that. So I would say that means rates go down, right? And yield is going to be super valuable again. So real estate, the income assets in a place like the States will be the store of value, I would think, in something that deflates what should be a rising economy. But we'll see. I mean, I think London office is the greatest short in the world, followed by Tokyo office. Tokyo is massively overbuilt in the office space because they have zero interest rates. And so they're building in Tokyo. I saw a presentation from a hedge fund. If you could figure out how to short it, you make a lot of money. I can't figure that out yet. I'm trying. And what do you think the best place to invest today is, Eric?
My picks are probably Europe. The debt in the UK, value-added opportunities in the better economies of Europe are the best plays. With a little bit of, if ever the shakiness in Mexico could lead to some pricing coming down in the industrial space, we'd be big buyers in Mexico as well.
What do you think the best thing to do today with your money in property is?
Just invest in Texas.
Yeah, I agree.
It's a big state. You got a lot of
How about
opportunities.
that?
Your governor's really happy. Your fellow Texans are happy. Sam, what are you doing? What do you want to do with money today besides writing a book?
We wouldn't invest in Europe, but we think Brazil is very attractive right now. We think Mexico is very attractive right
Colombia?
now. I'm sorry?
Colombia?
We have invested in Colombia. We have some significant investments there right now. The problem with Colombia is that it's next door to Venezuela. And I think Venezuela is going to explode. And Colombia will be dramatically impacted. They talk about, the North Koreans, running into China. The Venezuelans are going to run into Colombia and create massive problems.
Okay, we'll skip that one.
Barry, there's a gentleman with a question right there.
There's a question there? Go ahead, sorry.
I'm from Detroit, Michigan. I've been living downtown for 4 years now. It's been a major revival there, and I'm starting to see more and more investors that are not from the Detroit area interested in the market. Just curious if any of you guys have any thoughts and have any interest in Detroit.
What a great story that is. One guy's impact on that city has been incredible.
Look, I actually spent 5 years as a kid in Detroit, and I've been trying to look at Detroit to make it make economic sense. And one of the challenges Detroit has is a city built for 2 million people. And right now there's about 600,000 residents in Detroit, and so they still have to maintain an infrastructure for a city that's got the sprawl of 2 million people. And there's not much job growth there. In fact, other than what Dan Gilbert has done down there, there's not been enough of a broader investment attraction there. So the fundamentals seem to be challenging. But near University of Detroit and the Arts District, that's been an appealing investment for people who reverse commute. So what's happening out there a bit is people are reverse commuting from the suburbs into Detroit. They live in Detroit and they go out to the suburbs because all of the entertainment is downtown. So I think that's probably why you're living there. But the challenge is, in terms of any massive amount, rents are so low, it's challenging to make economics work. Retail core there is not doing really well either. I don't know about anybody else.
Well, I'd just like to take a bigger leap off of that question, because I think I don't understand investing internationally. I like investing locally. I like investing in the United States. I like being here. It's the most stable market in the world. And I'm sure there's reasons why
Well,
you're
you and
going
I are
internationally.
developers, and Barry and
Yeah,
Sam
we're
are global
We're
financiers.
building from the ground up.
And,
But I would tell you, I think there's great opportunities.
and developers.
Great opportunities and a revival in the old main streets. People nowadays, they want to live, work, congregate, socialize, educate their children with a sense of community. The world is unsafe. There's more anxiety in the world today, particularly in the United States, than ever before. There's a sense of community that people are looking for. So I think the old main streets, the old towns, and I've been around a lot of them in the country, there's a revival coming back, which is fantastic. So it may be a longer-term investment, but I think it will pay off huge. And it will be across the classes, hotel, residential, and retail.
Oh, go ahead, sorry.
You know, the subject of hotels came up. Rick, I drove by with curiosity at your project up there in Montecito. Can you talk a little bit about what you're doing?
Sure. So we're under construction on the old Miramar Hotel. The Miramar was there for about 100 years. It's in Montecito, right south of Santa Barbara, about an hour from here, up the coast. Very tough to get entitled. A lot of barriers to entry, which is good in terms of value creation. It will be the only five-star hotel actually on the beach in Southern California. And like Barry did years ago, he was genius in what he did in terms of the hotel business. We feel that we've got an opportunity to reinvent the model in terms of the levers to pull to drive revenue growth. But what I like about it the most is they're not making another 18 acres on the beach in Southern California. It's the only hotel you'll open your door and you'll step on the sand.
How many keys is it?
What's that?
How many keys is it?
161. Mostly bungalows and then beachfront and a restaurant right on the beach also. So we opened that in June of 2018.
Go ahead.
Can you talk briefly about SFR and your company SFR?
Oh,
And where do you rate number 1, 2, 3 over the next 5 or 10 years different real estate companies? What would be your favorite that's for the next 5 or 10 years for return?
so SFR is Colony Starwood Homes. We're the third largest player in this single family. We bought the houses and we rent them. And it's turned into a crazy good business. The stock's up 50%. The margins are the same as apartments, 65%. I'm astonished. I had no idea this business would be this good. I didn't even know it was a business. But it worked out great. Our yields are, it's a different renter because it's usually a higher, better credit than an apartment, and it's often a family. And we've basically inhaled all the people who were thrown out of their homes, and they've taken to renting homes. And they don't seem to have any proclivity to want to buy the home. So, same-store sales growth is like 6%. Our apartments are almost 6%. And margins are the same. Leverage is better. You can lever the pisser out of homes if you want to, although we can't in the public company. We argue about that, what leverage level should we run the public company. There are enormous economies of scale. With 30,000 homes and the way we've aggregated them by city, we can run them much better than you can. And they've built amazing technology where they don't even go to the home to rent it. It's all on the keypad, and they send them there, and they put the key, they plug in a code, they go look at the house themselves, and we know exactly how much to pay for the house because we know exactly how long and what it rented for. So, the house next door, so we have amazing data. And I think it's, there's three of us now. Blackstone went public, and I think it's a legitimate asset class. America can play the housing market. We get two returns. We get, obviously, rental growth and income, and we get HPA, home price appreciation. And total returns levered are very competitive. So it's a very good business, and the stocks have traded pretty well. We trade a little lower than the other guys in multiples, but 17 and 20 times FFO, right alongside the apartments. And some money's come out of apartments as the market's gotten a little toppy. The public companies own very nice real estate, and that's been the toughest place to be. We focused more on B apartments, and that has been our major thing. I just want to close with one question I want to ask everybody, because I'm confused. We've talked about a lot of topics. Are you bearish, bullish, or neutral over the next, most of us invest for 5-year cycles, but the next 5 years? I mean, is anybody bearish? How about that?
I mean,
On U.S., just U.S. real estate in general.
On U.S., I guess
Are we at a top?
we're neutral. I'd say when I look at our U.S., we're forced net sellers. And here's what I mean by that is we'd like to buy, but prices are high, and everyone's looking at the same assets, right? And prices are high, so the stuff we want to sell is selling quite well. So in
This
a way,
is a
we're
one-word
neutral.
answer. We're out of time. So bullish, bearish,
Bullish.
or bullish?
Bullish.
Oh, I'm bullish.
I get that you're a developer.
Yeah,
You live in Texas, so I don't even have to ask you.
always not.
I mean, this state is really working. You should. And we own stuff in Texas. We never own Texas, and maybe we have a huge apartment portfolio, and it's crushing it. It's one of the great markets in the States. By the way, Detroit has the best apartment market in the United States right now. Lowest vacancy rates and highest rental growth. Sam,
Neutral,
you're neutral.
at best.
I know you're saying that because Donald's going to rewrite the whole American fiscal policy. I hope you enjoy this. I think I'll sum up by saying, I mean, we think rise in rates will be met by a rise and we hope Donald gets some of his fiscal stimulus done because it will create wage growth. We're at 4.5% unemployment. We get wage growth, retail sales go up, apartment rents go up, jobs are created, and this divide in the economy gets a little less noticeable, and then we can get to the business of creating jobs for America. Thanks for coming today.
Thank you.